Welcome to the webinar, Immaculate Enterprises Private Lending 101. This is our disclaimer. This is not a public offering or an invitation to sell securities or make an investment. Securities may only be offered or sold in the state or states where they are registered or under an exempt offering. This is an informational, learning webinar, so put your wallets away. This webinar is for you to learn how to become a private lender. Obviously, you have interest. You would not have shown up to the webinar if you did not. Private lending can be another income stream. Private lending can be secured by realty, so it's secured by real estate. Different types of real estate when we do have our private lenders, but this is for your information only. Investing and lending is another form of a passive income. Everybody already knows about having residual type incomes. So private lending is actually very passive. You don't have to have a lot of involvement. Many investors use private lending to diversify their portfolios. So if you're a stock options trader or buy stock, sell stock, this is another vehicle to just be able to examine a proposal or a prospectus, whichever one you're comfortable with, and then decide whether or not you're going to go ahead and invest your money in that particular proposal. As a investor, you do not share the same risk as a real estate investor. So if you're wondering what happens if something goes wrong, we'll address that in the latter part of the webinar. But you do not share the same types of risks as the real estate investor does. So why do people shy away from private lending? It seems so easy. It's passive income. You don't have a same risk as a real estate investor has. So why do people shy away? Because a confused mind says no. Lack of understanding of private lending is also another reason people shy away. Feeling of being cheated. So they think that, if I get like a Ponzi scheme, you give someone money, they tell you this is what they're doing. There are ways around the feeling of being cheated, and you'll see in future slides. The feeling of losing their investment. If it's a Ponzi scheme, you lose your investment. Or what if the real estate investor overestimated the profit margin or overestimated the resale of a property, the ability to sell that property? What if they didn't do their homework? You could lose your investment because you backed the wrong type of information. Or do you feel like you're going to be duped, like in a Ponzi scheme? How do you guard yourself? How do you fix this problem? How do you address those risk issues? How do you keep from losing your hard-earned money? The answer is very easy. It's in the paperwork. If you have a person telling you of a deal, we'll call the real estate investments deals from here on out. So if you have a person telling you about a deal, but yet they never give you any paperwork, you might want to think that's a little sketchy. Ask questions. Always ask questions. You should be able to ask questions. If the person can't answer the question right off the bat, then maybe they have to go look it up. Give them time to get back to you on the answer. Ask what papers you will receive. What types of information are you supposed to have for the property? So once you've, let's say, committed to lending on the property, what do you get for your money? What papers will you have to sign? Of course, you should be able to sign things. Committing to money, you have to sign something. Are you thinking of using, what vehicle are you going to use to invest in the real estate or into the deal? Are you going to use your 401k or self-directed IRA? Both of those have different types of tax advantages. Are you going to use money that you have on hand already? Maybe you have $100,000 sitting in a checking account and you're thinking, what can I put this in to earn better interest than a savings account? If you do use your 401k or self-directed IRA, who will be your trustee? Do you know who the trustee is? So who's the trustee? Your banking institution is the trustee. So if your bank allows you to put your 401k or your self-directed IRA into real estate, not all do, then you go ahead and decide at that point. The investor borrower is not your trustee. Ask questions of your banking institution. back to the bank and see if they allow real estate investments with your 401k or with your self-directed IRA. Ask what types of investments they will allow. They don't always allow those. Not all do. Very small amount do. Not all banking institutions handle real estate investments. When investing with a self-directed IRA or 401k, most institutions which handle real estate transaction investments will let you know the items needed to complete the loan. But I'm going to still tell you the items that we will give you, and you compare that with what the bank tells you. The fire insurance, what if you invest in it today and tomorrow it burns down? You need the fire insurance. After repair appraisal, An after repair appraisal is, what is this property worth after all the necessary repairs? There are a few properties out there that maybe it needs $36,000 in plumbing repair. So if repair, the property's not worth but $50,000 in maybe a $170,000 area. Transaction being placed in escrow for professional close. You also receive a termite report. And it's set up with a mortgage servicing company. So it's not, I'm going to be sending you your mortgage, or the company that you invest in will be sending you a mortgage. It'll be set up with a professional mortgage servicing company, just like the banks do. Same thing. After closing, to receive hazard insurance policy, mortgage on the property, of course you have the promissory note, and lender title insurance. That also backs the lender for whatever title issues could arise. Mortgage on the property, promissory note, lender title insurance. Another thing to consider, different investors, different interest rates do vary from investor to investor. Also, the collateral for the loan should be clearly stated on the loan papers. You, the lender, should be designated on the loan papers as the lender. You should also be specified as lender on the title insurance. Also as lender on the fire insurance policy. As an added bonus, if you were wondering, what if Andrea dies? What if the key person dies prematurely? They're setting up the deal and the deal goes through. You funded the deal, we've closed escrow, and the day after escrow, the person passes away. Don't worry, there's an insurance for that too, the key person insurance. Key person insurance will cover the loan, so that way your investment is still protected. So even in the event of an untimely death, your loan is covered. Another added bonus, instructions for the property. Meaning that if the person were to pass away, there are instructions left. Whether to hold, the exit strategy is thoroughly let out. And as the lender, if you don't like the exit strategy or have an idea of something different, you can override the instructions. What if the borrower can't pay as agreed? That's also a consideration. If they mistimed the market, mispriced the property to sell or maybe the rental, what happens when they can't make the note? What happens to your investment? The private lender has all the rights of a regular banking institution lender. What was the lender in the banking will do? Foreclose. You can foreclose and resell the property or even keep the property. Maybe you know better. How much money is at risk? In all investments, risks exist. There's no way around it. Even a CD has a small amount of risk, even though CD rates are very low. Minimizing risk is the key to profitable investments. So how do you minimize the risk on real estate, especially when we've had a past rockiness and that's starting to trend out to better, more stability now? The risk minimizer is the loan to value. Normally the loan to value, which we'll keep calling LTV, so remember loan to value. Loan to value is kept low. We have normally 65 to 70% with our properties. 75% is on a case-by-case basis. So that means that's basically a very stellar deal to have a 75% loan to value. Risk minimizer, properties with equity. That's why we have the low loan to value. That gives you more equity. After repair appraisal may actually give you even more equity in a property. So what types of collateral can a private lender expect? Notes, Yes, going into purchase at a discount. And when I mean notes, I mean what you're going to actually have on a property is a note. So if you take the note and decide you want to go and resell the note, you can resell the note. Just remember, people are always looking for a discount on any type of note, whether non-performing or performing. Non-performing is a note where no one's paying on it. Performing, of course, you're getting payments all the time. Performing notes, okay, smaller discount than non-performing. Single-family residences, mostly bank foreclosures. We also do pre-foreclosures, and which are properties where the homeowner needs help keeping the home. What we do is we have a proprietary blend where we go in and bargain for the note with the owner's permission. And then once we bargain for the note, we can go from there with the steps to avoid the foreclosure, provided the person still has an income that will actually carry a note. With a lot of people, loan resets are the major reason for a lot of the foreclosures we have now, which is why we have the loan modifications. Multifamily, also known as apartments, so that's 5 units and above considered commercial property, and that's where we go, 5 units and above. But in actuality, we actually go more into the 15 units up to, at this point, 250. Commercial property such as what you see, office spaces. But like I said, apartments are considered commercial property as well. Mixed use, where it's living on the top and stores on the bottom, and office spaces. Land, yes, undeveloped land. Development projects, which is why we have the undeveloped land. Note for development projects, there is a higher risk, slightly higher risk with the development project because it's built on speculation. Will you know the difference between before agreeing to lend? Of course, we send you a prospectus or a proposal. You will know the property type you're going to be given information to invest in. That way you can make a better and informed decision. Remember, you'll be given paperwork as well. Remember the title, fire, lender, and key purse insurances. And after repair appraisal, a transaction is being placed in professional close, and you'll have a termite report. And it will be set up with a mortgage servicing company. After closing, what are you going to receive again? You receive the hazard insurance policy, mortgage on the property, promissory note, and lender title insurance. Every investment property supports itself. I know that was some question for a few people. What if you're buying B based on getting A, and A is a separate lender from B, and that equals C? No, that doesn't work. All properties have to support themselves. So every one of the properties that you're investing in or that you choose to invest in should only support the property itself, not depend on another property being purchased and not depend on another one being sold. Properties are not purchased based on another property. All investments are independent of each other. Properties are also placed in beneficial tax structures such as LLC and LP. It depends on what we're actually going to do with the property, whether we're holding the property, whether we're going to sell the property immediately, whether we're renting the property. Yeah. The structure depends on what we're going to do with the property, our intentions. Whether rental or lease option, yes, we do have lease options, or sell it out, flip, what other people call flipping. Now look at the current CD rates. We went on and looked at this. This is about 3 weeks ago. A 1-year CD. That's an interesting rate of return. 0.65% after 1 year. I think that came out to $3.25 on a $1,000 investment. On a $1,000 investment. But if you're being in the bank, as far as our interest rates are concerned, not everyone else's, we do from 4 to 8%. 4% is the new investor. 8% is a seasoned investor with us. So it means we've come to you, you've been very good about, closing, coming in and closing. So that's the 8%. The 4% is when you're just starting off. And we also do compounding differently than other people. So we have compounding annually, semi-annually, monthly. But like I said, it's not too good to be true, the 4 to 8%, especially when you're looking at current interest rates. Current interest rates are 2 1/4 and to 3%. So why would we pay 4%? Well, it makes it easier for us to close. A bank tends to put more into not closing. Banks seem to be very stale with money at this point in time, so it's good to just go out to a private lender. That way everybody's making money. Or you can just invest in a CD. These are the emerging trend areas. This is something we thought everybody should have an idea of. We can send you, if you would like to be sent the actual write-up from PricewaterhouseCoopers, we'll send that to you. They've changed their names now to Urban Land Institute. But right now, if you look at the areas, San Francisco, it's #1 for investment, meaning that investment properties, #1 for development, and #1 for housing. So of course, that no wonder their prices are higher. They do have very high prices in San Francisco, but when you can find a deal that someone's about to sell in San Francisco, everyone jumps on it. So closing fast is the best thing for that. Closing in 3 days instead of 5 to 7. If anyone can put their money in quickly, that's what you do. Close in San Francisco quickly. Houston is next. Actually, it's #5, and this is on a scale of 50. So this is #5 is Houston. Most people wouldn't think down in Texas, but it's #5 for investment, #5 for development, and 6 for housing. And right now they have a few computer companies that are going in and setting up base in different parts of Houston. So right now we're looking for, of course, apartment rentals and houses in Houston. And the Dallas-Fort Worth area, they're redesigning themselves. They've been redesigning themselves for the past 15 to 20 years now. So they're #10 in investment, 7 in development, and 10 in housing, and anticipated to actually start inching up even higher. Los Angeles, of course, our hometown, we're #14 in investment, 15 in development, and 14 in housing. Chicago, yet another Windy City area, 20 in investment, 24 in development, and 31 in housing. I would think Chicago would be a little bit better, but this is what PricewaterhouseCoopers Waterhouse has said. San Antonio, yet another Texas area, 22 in investment, 18 in development, 17 in housing. These are when you're looking at the housing, that's the baby boomers that are going to be what they call them echo boomers. These are the ones that are now in the group of 24 to 35. The housing market is going to rebound within the next 2 years, even better than what it was before the crash. Houston, San Antonio, Austin, Texas, #7, 4 in development, and 5 in housing. The reason why we posted these areas, these are the areas that we are looking for real estate in. These are our emerging areas. But like I said, if you would like the entire document, you can go over to urbanlandinstitute.com, or we can email it to you. So a quick recap, if anybody has any more questions, please make sure that you send us all the questions. We hope that you have gained a lot of knowledge from this, and if we didn't give you the knowledge that you thought you were getting, email us your questions. So with all that knowledge, you should be able to increase your investments. So don't always invest in that CD, I guess, but 0.65%, that has extremely low risk. So create multiple passive streams of income with private lending. You want more information? Just fill out the form. And we will see you later. Goodbye, everybody.